Good evening, everybody. Not good morning. It is Monday night, March 9th, 2020, and we are in the throes of the coronavirus crash, the oil crash, and what I've been calling since the middle of 2018, Crash 2020, hashtag Crash 2020 if you're following along on Twitter. I'm going to talk just a little bit about how I've known that we had a crash coming this year and why I think it might be a double crash. Basically, this front end of the volatility that I talked about in my annual review, and also the year-end things that I expect based on, some things that I just can tell were coming. Based on the information and the data that I've been collecting for years. So it really boils down to experience at some point, knowing what really causes things to happen with regard to, say, tax cuts and deficit running and regulation. Almost nobody understands the underlying regulations in the banking system. I took a crash course in that in 2007 and 8. And, I think that most people have forgotten what happened in 2007 and 2008. In particular, I think that a lot of millennials just simply are, unaware. And, that's, neither here nor there. They just don't know what occurred in 2007 and 8 other than some very basic ideas that they sort of remember from when they were teenagers. So I don't know how the follow-throughs are going to work on everything because I don't think we know where the stock market really is anymore. I truly don't know that we know that. And we have to take into account the major technical levels, and we'll look at some of those today. We will think about what's really going on and what we should expect through the year end. So if you haven't read my 2020 outlook, I encourage you to go to Seeking Alpha and do that. The title was 2020 Outlook, Euphoria to Despair. And I talked about a market top, early season volatility, that valuations were already stretched. And I had talked to Mark Yusko a long time ago, basically saying in 2018, you can see this is July 6, 2018, he thought that the stock market was into the delusional phase way back then. And I suggested, well, I think we were only in enthusiasm back then. Well, at the end of 2019, we got that big rally into January, and I think that marked euphoria, which is what I talked about in my New Year's letter. And my comment to him was, bet you a nickel, maybe even a dime, that we get a 9 to 19% correction, and then SPY would run in, past 300 in 2019. And in fact, that's exactly what happened. We got a 19% correction at the end of 2008. Oh, this is 2017. So we got the first correction at the start of 2018. Those of you who were with me then, we made a lot of money on the volatility trade. And then, wow, this is 2.5 years ago, not a year and a half ago. Wow, I've been on this a while. But then at the end of 2018, the market dropped 19% and just missed becoming an official bear market. So read this to get a general outline of what I'm thinking for the year. I say something in here about the election that half of you won't like. But essentially, it's just based on data from family offices and hedge funds that do their own private polling data. And it's never been wrong since Kennedy. They've been doing it since the Kennedy election, and they've never gotten it wrong. So they have very specific polling data where they send people out to knock on doors and walk through a questionnaire with people, hundreds and hundreds of them in key counties, in key states, and they've never gotten a presidential election wrong. So I have some expectations about what will happen in the fall. So go ahead and read this over at Seeking Alpha. Next day, I talked about expect major stock market challenges, that we would get a volatility event. And it doesn't matter, and I've talked about this at other webinars in the last several weeks, it did not matter that it was coronavirus. Could have been anything. It would have happened with this oil conflict between Russia and Saudi Arabia over the weekend. Probably would have happened with a slowdown in earnings. So whether it was coronavirus or something else, I am convinced that we were going to have some sort of earlier correction. Now, will it be more severe because of coronavirus? I believe it will, because right now we're forecasting out about a $3 trillion loss of GDP due to what might become a pandemic soon. And it could be 4, 5, 6, 7, $8 trillion. We don't know yet. So that's the problem with coronavirus, is that there's a lot of unknowns. So a lot of businesses are slamming on the brakes and spending, and that's going to cause a lot of lost GDP, which is going to cause a lot of profits not being made. And that money doesn't come back. That's just gone. You know, there's not going to be pent-up demand. Supply chains are on time as it is. So there will be a little bit of inventory building, but not much, unless this really stretches out a long time. So I believe you should just expect certain piles of money to be gone, delayed way into the future. And think about it as, yeah, it'll get here, but it's going to be way down the road. So I don't anticipate a V-shaped recovery at all. You know, and I think that parts of the economy, specific companies in the S&P 500, they'll get more of an L-shaped recovery. And think of it as an upside down smile, where a lot of the S&P stocks will start to rise, but then as other better names go up, these names will turn back over and go back down and double test their bottoms. Why do I think that? My research shows that between 100 and 150 companies in the S&P 500 are in danger of losing between 50 and 100% by the end of the decade. And in the last, today really, Friday and today, a lot of the oil stocks lost 50%. So I don't think it should be so outlandish that I'm saying that. Folks who are subscribers, and I don't know who's a member and who's not on this call, but people who are members of the services, they see my bottom fishing prices on a lot of stocks, and they're like, well, we're 50% or 200% or 85% above the bottom fishing price. I'm like, yeah. They're like, well, when will that ever happen? And we'll take a look at December 8, 2018. A lot of stocks hit our bottom fishing prices. So, you know, this correction has the potential to go much, much deeper. And, you know, I just kind of talked to you about, you know, coronavirus was really just a match that lit the overvaluation tinder. You should read this article as well to get a refresher on where valuations were. You know, the stock market is at a historical overvaluation on virtually every measure. And the Federal Reserve, being at these super low interest rates, it started to lose effectiveness. Think about Japan. Japan's had essentially zero interest rates for a very long time, and they just can't get their stock market to break out. There's got to be another solution. Buffett indicator is that, you know, what's the replacement value for a company versus buying its stock? You know, he does it on the whole GDP level. You know, we really have a long way to go before companies are affordable versus just starting a new company. We're not there yet. You know, we're back down to about here, about this level. So we still have another tumble yet to go. So a couple of weeks ago, I suggested that coronavirus would spur a much deeper S&P 500 correction. Read the comments on here, 402 comments. And just, if you got 20 minutes to go through these. Look at how many people basically said I was stupid, that this was made up, it was fake news, and that the stock market was going to come roaring back. It's, those folks aren't posting right now. So today, if you are not a member of Margin of Safety Investing or Fundamental Trends, and this is on Margin of Safety Investing, but it's also on Fundamental Trends, is a chart book with some investing ideas, and that's what we're going to cover today. All you need is a free library card to see this. So I'll just go right here, see the little kid, and sign up for a free library card. And click on free library card, piece of cake. Don't even need a code. And you can get access to quite a bit of my content, either delayed, but I do give you the special reports, legacy content, and then quarterly outlook and game plan. So if you want to see kind of what I've said in the past, what other analysts are saying, and see the special reports as they come out, about one a quarter, free library card. So let's take a look at what I want to talk about today, and that is, I'm going to pump this up a little bit. There we go. Talk about exchange traded funds, and really what types of investing ideas I think are important going forward. And I have the prices that I have set right here. I don't know that you can expect these prices to be perfect. And the reason for that is that, like I said, the underlying structure of the stock market is much different today than it was 5 years ago, than it was 10 years ago, and especially 20 and 25 and 30 years ago. The stock market has changed dramatically based on who is investing and how much they're investing. And that has largely been driven by two things. The aging demographics, basically the baby boomers and institutions that hold money for baby boomers are in perpetual sell modes. Most baby boomers, about half of baby boomers, are retired already, but the pensions, because they don't have any new money coming in, right? There's millennials and Xers really don't have pensions except a handful of public people, but almost all the private companies have gone to 401k. They're in perpetual selling mode. So I've showed those charts from Yardeni. The pensions are in forever selling. They're never going to buy again. So you need to keep that in mind as they're selling to pay those checks. The corporate pensions are generally in good shape. However, the public pensions from municipality to municipality are roughly $6 trillion short, and at some point they're going to need a bailout by the federal government. So what do we know about stock market corrections? All corrections are your chance to upgrade your asset allocation to higher quality and higher growth. This correction isn't any different. So I want you to think about what you want your portfolio to do for you over the next 10 years. If you go to the webinar page, Investor 2020s by Kirk Spano over on YouTube, and you can find those links all over the place, you'll see that I talk about the 2020s being a lot like the 2000s as far as the stock market is concerned. I think that it's very likely that the next decade, this decade, the 2020s, do not mirror the 2010 to 2019 period at all. I think we are very likely to see a period like 2000 to 2009, a couple of recessions, maybe 3 recessions, and 2 or 3 pretty significant stock market corrections. And remember, 20 to 30% stock market corrections are really run of the mill. And I know people don't believe that right now because we haven't had one. We haven't had a legitimate bear market yet since 2009. But 2 or 3 bear markets per decade is normal. And for you to manage that, there's really only a couple things you can do. You can be an index investor and just say, I'm willing to take the average. Well, the average during the 2000s, from 2000 to 2009, was 2%, right? Because all you got was the dividend. That's not uncommon. There's been 3 other periods like that since including the Great Depression. So in the 70s, you had another period like that. You had basically a lost decade. So there's been 2 lost decades for stock market investors post World War II. And if you go to the Great Depression, you had that before that. So it's not uncommon in a 100-year period to have 3 or 4 decades where the stock market doesn't make any money. And I believe that's about what we're going to see now. Why? Because the S&P 500 has a lot of crippled companies. And that's the measuring stick. The Dow Jones Industrial Average probably improves because the oil companies are going to get kicked out soon. And they'll be replaced with technology companies most likely. And that will help the Dow Jones Industrial Average. Anybody answer why certain almost $1 trillion companies aren't in the Dow Jones Industrial Average, but Exxon and Chevron are? It doesn't make any sense, right? So, maybe I misspoke here, but Dow Jones Industrial components. If we take a look at that real quick, should have had this one fired up. We'll just use Yahoo since, hey, it's easy to find. Not easy to move. I don't know where it went. Here we go. Oh, here we go. There you go. So you take a look at these components and you ask yourself some questions. You say, why is Exxon in there? Why is Chevron in there? These are dying industries. And I don't mean like tomorrow, but they're dying industries. Fossil fuels are slowly going away, starting with coal, then oil, then natural gas over the next 10, 20, and 30 years, basically. And those companies need to be replaced for the Dow to do better. Subscribers know that I like a lot of these companies. I don't know why Travelers is in here anymore. I have no idea. So the Dow Jones is going to get some rejiggering as well. But the S&P 500, as I've talked about, 100 to 150 companies are broken. And they don't have growth, but they have high debt. Well, how do you pay off your debts if you don't have any growth? Right? You have to cut your dividends. You can't do buybacks. You got to pay people less. It's just a reinforcing negative loop. So where you want to upgrade to is we are at the beginning of the 4th Industrial Revolution. I've talked about this since I got back from the Consumer Electronics Show. We're entering the smart everything world, alternative energy, and right here, and this is from ARK Investments, this is really where all the money is being made. Biotech, AI, alternative energy and energy storage, machine learning, IoT and cloud, and then blockchain and fintech. And I think the weakest one here is blockchain and fintech because nobody knows how to use it yet. But if they figure it out, it's big money because it essentially replaces the banks. And what did I say on Friday and 10 other times in the last couple of years? Why would anybody own a bank? If you own a bank stock, I have no idea why you've been doing it. You could have owned Apple, which has more money, less risk, and more growth, and no debt, and less exposure to the economy than a bank. Yeah, you wouldn't have gotten the 5% dividend that the banks are paying, some of the banks are paying now, but you wouldn't have lost 20% today either. So if you really want a bank stock, buy Google and Apple instead, because they have way more money than anybody else and better businesses. And at this point, with interest rates likely to stay super low, hopefully we don't get NERP. We've had LERP, low interest rate policy, for a long time. We're almost at the zero bound, so we're almost at ZERP. And, President Trump would like to have NERP. Why don't we go to negative interest rates? He's a real estate guy. Why wouldn't he say that? So there's no reason to have money in the banks as far as an investment. You're better off owning secular growers that have fortress balance sheets. I will tell you, Apple and Google have far less risk than any bank on the planet. Any bank on the planet that you can invest in. Maybe there's some private banks. So, where do we want to invest? Well, let's start with your index fund. You don't want to own the S&P 500. I just kind of went through why, and we've talked about it before. I'll have more articles out on it, but the S&P 500 is not where you want to be. You want to be in the Invesco QQQ. These are the 100 stocks in the NASDAQ 100, led by Apple, Microsoft, Amazon, and Google, which represent about 39% of the fund. Now, what do subscribers know about those 4 stocks? These are all on my must-own list. So if you can get them through QQQ, that makes your account management much easier. QQQ has crushed the S&P 500 for total return, including the dot-com crash. In the last 10 years, it's even more dramatic, right? The S&P 500 almost just half, about 60% of what QQQ made. So yeah, you got about 1.5% extra in dividend at the expense of not getting any of that. So here's a monthly chart on QQQ. Green means that institutions are favorable on this. Institutions love this thing, right? And they love the companies underlying it. Why? The companies in QQQ, those 100 companies, out of about 5,000 stocks on the stock market, have about 70% of the cash. That's a big deal. These are the companies that make all the money. These are the real blue chips. Now, I'm not saying there's not more blue chips. You can cherry pick blue chips out of the S&P 500, but this group of 100 stocks is almost all blue chip stocks. Almost all of them. Take a look at the weekly chart, and what you find is that we're at the kind of the minor support levels right now. Are we going to break through at the end of the week? Are we going to go below that 85 level on the S&P 500? If we do, we're probably headed down to around 150, and maybe even down to around 120. So this box, I'd want to buy at this first line and buy again at this second line. And I talk about how the weekly and daily and monthly charts interplay. On the daily chart, we're oversold. So you could see a little bounce back tomorrow. I suspect the market opens down tomorrow and then rebounds later in the day. Maybe even has an up day on Wednesday. And then we'll see what happens on Thursday and Friday. If Thursday is bad, Friday's almost for sure going to be bad. So I currently have buy orders on QQQ at 150, nothing higher. Chart tells me that's the start of the major support. Now, could I adjust this trade at some point? Sure. If the world suddenly gets better, if there's a fiscal stimulus rally, yeah, so maybe I would trade it a little bit. But I think more likely is if we get a rally off of our current levels, I'm probably just going to sell even more of what I own. And that's because I believe that the end of the year is going to be rough too. The ARK Innovation Fund. This is about 30 to 40 companies managed by Kathy Wood that has been awesome since its inception. It's beaten QQQ. Now, this is a group of companies that's a little bit more eclectic. She picks them out for innovation. She has a great team. I encourage you to go to her website and read the research. These are the companies that we talked about, or that we took a look at this earlier on. This is her chart. This is what she's investing in. A lot of those are mid caps, but she also has companies like, and I had a list in here. Well, it's Square and Tesla's their biggest holding, and several others. Oh, here, I talk about that down here. So with a core of QQQ and ARC. You're getting about 130 stocks. That's plenty for diversification. It is tech heavy, there's no doubt about it, but also consumer discretionary and biotech and fintech, cloud, 5G, things like that. ARC holds companies like Tesla, Square, Illumina, those which are also QQQ holdings. So there's some overlap. Her fund is managed, meaning that she'll trade it for you, which means that you don't want to have as much in ARC as you do in QQQ. Why? Because QQQ is predictable. ARC, you know, she's been a great manager since inception, but what's to say she doesn't have a bad year? As I mentioned in here, you have to be able and willing to accept the risk that she takes the golden sombrero, which is, you know, 4 strikeout game. I've had a few of those. So, you know, because there's management risk here, you have to be careful. But in general, I like ARC at 38, maybe 36, maybe 40, but right in there, starting to close in. It's at about 47, 48 right now. But those are 2 great funds for the core of your portfolio. What do you add to it? 2020s will be the solar and storage decade. Mark my words, solar is going to continue to grow fast. The last several years, even under President Trump, you've seen 20% growth rates. Prior to President Trump, you saw 30 and 40% growth rates, and even some 50% growth rates, but those are off pretty small numbers. So expect 20+% growth rates, and I think probably ramping up towards 30% if a Democrat wins the presidency. Read my annual outlook. So over the last 3 years, ARC has been the top performer, followed by the solar ETF. I don't even know if people know that. And most of that has come in the last year. TAN went on a huge rally. You're getting this pullback right now. This is a golden opportunity. See the 3 lines? This is a golden opportunity to buy TAN. So when we take a look at the charts, here's your weekly chart. And this 26 to 30 range appears to be a pretty strong support zone. So I have my orders in at 26 bucks. There's downside to 20, so you should know that. Don't jump in all at once, but maybe break your position up into 2 or 3 buys, and just make sure that if it goes to 20, you know, you have still about half of your money to invest. And if the world suddenly gets better, you quick get it in. Probably won't have as much in this as you do in ARC because it's a very focused portfolio. And remember, ARC is going to have a little bit of solar and storage and alternative energy because that's one of her planks. In a stock portfolio, you might only have 4 to 8% in TAN because there are 2 to 4 individual solar names that we like. And I think we might find a battery company at some point. Although I'm more interested in energy storage management than the actual physical batteries, because I think everybody's going to have good batteries at some point. There's not going to be a huge technological difference between batteries because of all the competition. But companies that can sell management systems are going to do well. Think of software as a service, right? Think of Salesforce. Companies that can do software as a service do very well. And a couple of our companies do that. So if you're a member, you'll get to learn who the stocks are we're buying within TAN. There's 3 of them right now, and Tesla. Tesla's the other one. But right now I'm not, I don't own Tesla. We bought it under 200, sold it in most of it in the 400s, and some people held it a little longer. I expect Tesla to come back under 400 at some point, maybe under 300. We'll see. Not because it's a bad company, but just because it just got away and ran way too high. So interestingly about Tesla is I presume most of you have heard of Reddit. Reddit is the blog network that a lot of millennials use. I actually have a premium membership just so I can keep track of it. See, I have 96 karma points. And they have some trading groups in here, and if it was professionals doing this, they'd go to jail. At least they'd get sued, and then they'd have to buy their way out of going to jail. But they talk about stocks, they buy a lot of call options, and they try to push the price up as kind of a way of blowing up short positions. It's not really ethical, but it's not really illegal either because they're not, hedge fund guys or brokerage guys. Although I suspect that there's hedge fund guys and brokerage guys planting the seeds and pushing the action. So just know that there's different ways with the internet and how the stocks get manipulated. And that's why some of these extremes are more extreme now. Is not only do the computers trade at a high speed, but you have people grouping up and trading. So we really need to be careful about getting to the edges of the market and not getting caught in the middle, because in the middle, you don't know if it's going to get pushed up or down. We need to find a way to find those turning points, either at tops or bottoms, and using comparisons of the daily, weekly, and monthly charts, especially for money flow and relative strength index, are very important. And then MACD really gives us an idea of how strong the momentum is. So what's next on my list? Semiconductors. They make the smart everything world go round. These are companies like NVIDIA, Intel, Texas Instruments, Qualcomm, Broadcom. The fund that I'm going to use is the iShares, I missed an S, Semiconductor ETF SOX. Why? It's the cheapest, biggest, best performing, and has liquid options. Okay, yeah, there's a bunch of good reasons, right? So let's take a look at this one's performance. And look, it gets better again. S&P 500 down here the last 5 years or so. Well, really, after now, it's basically S&P 500 hasn't made. Oh, this is solar. Solar's rally has been lately. Where's S&P 500? Here we go. S&P 500 right there. Right? So you see that solar just started to rally. It sucked before that. Just coming off the bottom. S&P 500, QQQ, ARC, and semiconductors. Take a look at these charts. This is the monthly chart on semiconductors. Look at all that green. The green is institutional bias, right? Red means institutions are selling. Green means institutions are accumulating. Now it's going to turn pink right in here in the last week or two. We just don't have the monthly chart updated because the month hasn't ended yet. But on the weekly chart, there's your pink, just starting. So if March ends down, which it certainly looks like it might, then you'd get a pink line on the monthly chart as well. Not oversold quite yet on the weekly chart, but heading in that direction. Money flow is about to go negative. Daily is oversold, but just barely. Money just went negative. Momentum is down. Has not even started to turn up yet. So what does that mean? There's still a lot of momentum to the downside, which is why I don't think this correction is over yet. I think we got another 10 to 20% to go. 2,400 on the S&P 500, 150-ish on QQQ, and it's 190 something right now. Those are some big drops yet. So with with SOX, it's over 200 right now yet, and I don't want to buy it until it's down to 160. This has had a history of being pretty volatile. Let's go back up to that monthly chart so you can see it. Look at that run up over the last 10 years. There's some room to come down to here for sure, which is an area I'm targeting. There's also room to come all the way down to 100. If we have a crisis, if this really turns into a full-grown economic crisis from coronavirus and oil and earnings, and if it just spirals out of control, this stock market could drop another 50% from here. I think that would be unusual. I think it's unlikely, but it's not impossible. So you should keep that in mind when your FOMO infused, itchy trigger finger to click, 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 buy starts to get to you. Look at these charts. Look back 10 years, right? Look back to where we came since the Great Recession. And I'm not so concerned about the lows of the Great Recession, but look at the highs right before the Great Recession and how long it took to break out. All the way to 2014, 13 and 14 is when we broke out. And the breakout in most stocks coincided with what? The crash in oil prices. And then we got the extra juice from the tax breaks. So if we go all the way back up to QQQ, here QQQ, go all the way back up to QQQ, and we go back and we have the crash, 2008-9, doesn't look that intimidating there, does it? And it finally gets back above its highs, about 2013. Oil gets cheap, big rally. President Trump comes in and cuts taxes, big rally. And now the tax breaks are wearing off. Monetary policy is less effective. Oil is super cheap right now, but does anybody expect that to last? We are about to see a lot of oil companies go bankrupt. And what is that going to impact? Could it impact solar? Sure. In the very short term, solar can get beat up. You're going to want to buy it when it does. Why? Because solar has all the positive catalysts that would make oil go up, right? If the price of oil goes up, not only do the oil companies make money, but that makes solar even more competitive. Here's the thing. Oil has a secular downtrend now. It's never going away, ever. Oil is not coming back. It's going to flatten out, which is already happening, and turn over by 2030, and I'm starting to think a few years sooner. Why? Because we know by law, car fleets have to get 52 miles to the gallon by 2025. President Trump is going to try to water that down next month, but if he doesn't win re-election, then it's going to get ramped right back up, and maybe we even start taxing gasoline. Let's say Bernie Sanders wins, right? I bet on Joe Biden. I got 6-1 odds because of the polls that I look at, which are way different than anything you see in the press. So don't ever give me that argument. Well, they said last time Trump was going to lose. Not what I was looking at. I have an indicator that's never been wrong since 1988. You know what that is? It's the mask that I wear for Halloween the year of an election. I have worn the correct presidential mask a month before the election, or whatever that is, for the Halloween parties. Every single time. I've gotten every one right since 1988. Some of them weren't so statistically based. I was just drunk. But I've been paying attention. I did study this in college. And right now, I would tell you, I'm not trying to anger anybody. I'm just telling you what the data is. And it's data that you don't get. But because of the people I know through MarketWatch that I got hooked up with when I was with MarketWatch, I know what this data is. And Stanley Druckenmiller, one of the richest, best investors in the world, talked about it to the New York Economics Club. President Trump's probably going to lose to whoever he runs against. It didn't matter if it was Biden or Bernie or Warren or Kamala Harris. It didn't matter who it was. About 10% of Republicans are staying home. They don't like him. They voted for him because they hated her, right? In the polls and the data questions that they're answering, they won't even say Hillary's name. I hated her, so I voted for him. And now I don't like him. So I'm just going to stay home, unless it's Biden, but I might vote for Biden. Why does that matter? Because the rich take these polls because they bet on it. They make stock market investments before the election based on who they think is going to win, and they always know who's going to win. It's essentially insider information. If you take a look at the trades that were made a few days before the last presidential election, it's because they all knew that Trump was going to win. And what happened 2 days after Trump won? Massive rally starts. They made those bets before the election. Well, how can they do that? They didn't know. They did know. And they know now. So unless something freakish happens and the polls change, President Trump probably isn't going to get 60 million votes next time. He got 63 million last time, and he needed 71,000 votes in 4 swing states to win. The odds of him winning again are somewhere around 8%. He's 9 out of 10 times likely to lose the next election. Doesn't mean he will. Just means it's probable, and we need to pay attention and set our ideology aside. As most of you know, I'm kind of liberal and I'm kind of a libertarian, so neither party is really all that attractive to me. I think that there's a duopoly running the country. They share power. They take turns cheating us. They take turns stealing. It's just a matter of how they do it. My opinion. There you go. That's all the politics you get tonight. So in any case, this stock market, here's the double top, right? QQQ 2000, and S&P came up here. This hadn't quite recovered by the correction, or by the Great Recession. This box represents major supports for QQQ. I want to buy in here. Where is the comparison to the S&P? Yeah, right there. So the S&P and QQQ had this flat period in 2015 going towards the election. And again, tax breaks and oil dropping in price. So that's something that we have to keep our eye on. What I think is going to happen in oil, and since I've talked a lot about oil for years, and I made a lot of money in it for 15 years, is that you're probably going to see a third of the oil companies go out of business now, either by merger or bankruptcy. And that's going to push the price of oil up probably next year. Again, especially if the polls are right and the Democrat wins, because they'll tighten up drilling on public lands and they'll stop issuing offshore permits. Then it doesn't matter if it's Bernie or Biden. Bernie would really clamp down with the EPA. Biden, somewhat. With shale going through another bankruptcy adjustment, this time there's no hot money. There's no bank money to bail them out. The last time, 4 or 5 years ago, the banks bailed out the oil industry. They're not going to do it again. They're already tightening the clamps, and in April, a lot of them have to review their revolvers, their loanable money. Most oil companies are going to be told by the banks next month, and then again in the fall, we're not giving you any extra money. You must produce out of cash flow or don't produce. And if you can't produce and pay your debts, we're going to take your companies from you. And the private equity firms, which are vultures, they want those assets for themselves at dirt cheap prices. Those companies will no longer be public. And because the money doesn't have to get distributed to shareholders, you'll have these private equity firms with 100 or 200 partners taking all the money from an oil company. And that's what's going to happen. You're going to have a lot of oil companies go private, and they're not going to look to grow. They're just going to suck every penny out and get as rich as they can. And that'll drive the price of oil up for you and me. And that's why I don't worry too much about alternative energy, because that's not going to happen there. They just get the benefit. Meanwhile, management and private equity are basically going to steal the oil industry. That's what's going to happen. So you can mention this to everybody and just remember this in 2 years when a third to half of the oil companies are no longer public and they've gone through bankruptcies, a lot of them, and managements and private equity firms take them private. It's just another theft of shareholder money. And these executives have been crooked for years, and they're screwing you. And they screwed me, and I'm over it now. I'm a little angry, and I'm going to take a lot of people's money. And I try to warn people about oil stocks now after having been extremely overly bullish through 2018. And the world just changed. It changed much faster than I thought it would. I thought what happened in the last 5 years with oil stocks would have taken 15 or 20 years to happen. and it moved way faster. And a lot of things are moving way faster now, and that's why you have to be careful. That's why I told everybody to raise 75% cash. At least 50 and up to 75. So your last investment here, after the semiconductors, and you don't have to buy the semiconductors or solar. You can get that stuff through QQQ and TAN, QQQ and ARC, but I would add some semiconductors and some solar because they have just done so well, and they will continue to do well in the next decade. Their upside ramps are huge. The semiconductors, with all the artificial intelligence coming, and everybody uses NVIDIA, this is a gift that we can get it this cheap soon. So the last one, gold is more than shine. I covered the massive bull market coming in gold and gold stocks. The bull market in gold stocks will be more than the bull market in gold. Gold, I think, goes to 3,000 by about 2030. But the gold stocks are leveraged to gold, and they only cost about $1,000 an ounce to get it out of the ground. So all that money from 1,500 to 3,000 or 1,600, whatever it is now, 1,700, whatever it is now, all drops to the bottom line of Newmont and Barrick and Silver Lake or all these other companies. So I like gold. I specifically like the gold miners ETF because the problem with gold stocks, and we learned this with core development recently, if they have a project go bad, it's a big deal. So you need to diversify your risk with gold miners, and I like the gold miner ETF. Interestingly, the charts are all pretty in the middle. I don't like in the middle, but I do think that there's a huge bull market coming in gold. So even though the monthly chart is kind of in the middle, I didn't put up the weekly and daily charts. The weekly and daily charts are showing some weakness now, but nothing overwhelming, and those are also in the middle. I think you can buy GDX at about 26, maybe even 28, right? It's going to go down a little bit with a market correction, but not much. It's held up pretty well. Every now and then there's margin calls, and that's when the gold gets sold off because people have a profitable position and they got paid for other stuff. So any daily or weekly sell-offs in gold stocks are probably a good place to buy. And I think that if you're doing a ETF portfolio, the standard common wisdom was put 5% in gold stocks. There was no reason for that. They just said, you should have some gold. Whatever. I think you go all the way up to around 12% in gold if you want to be assertive. And if you believe what I believe, which is we're going to print a lot of money in the next decade. We have to devalue all this debt. The only way to do it is by printing money. It's the only way to do it. There's not enough money in the world to collect via taxation to pay off all these debts that are starting to strangle us. Ultimately, helicopter money, a Milton Friedman idea from the 1960s, is at one time you drop a whole bunch of money on everything, and that fixes the problem, and then you get rid of your deflationary problem. We have a deflationary problem, not an inflationary problem, and that's something that people have to always wrap their heads around. Aging demographics drive deflation. As populations get older, deflation comes in. Now, Japan is in the grip of it and has been for a long time. China's on the verge of it. Europe's on the verge of it. We have the millennials as an offsetting component to our demographic picture. So our curve is a lot smoother. And that's why the United States is probably going to be the best place to invest for another generation or two. Someday the emerging markets will be the best place to invest. But I don't think yet. Not until the baby boomers the millennials. Not until the millennials get to their peak earning and spending years in about 10, 15 years, right? Because they started 5 to 10 years behind. So their peak spending and earning years aren't 40s and 50s, but rather 50s and 60s. A lot of millennials are going to still have kids in college in their 50s. but then there's not a lot of people behind them, right? The generation after the millennials, whatever they're calling them, and then the generation after that, they're not going to be giant generations. They're going to be more like the Xers, like my generation, 2/3 the size of the boomers and the millennials. So we're going to get a smoother curve here. A lot less aging demographic problems than Japan, China, and Europe. Think about that. We look at our Medicare and Social Security problems and we're just overwhelmed. Imagine what it's like in Japan, China, and Europe, which are older and poorer. We're richer than all of them. There's going to be a lot of money printed in the next decade. Gold's going to go up a lot. And it probably goes up more in other currencies. So if you're a futures trader, you saw that in my article today about oil, that I mentioned Forex analytics. So if you ever want to get a great video, go to Forex analytics and buying oil with no resurrection in sight. I mentioned Forex analytics down here. I don't think they pulled it out. I didn't make it bold. I didn't want it to stand out too much. But Forex analytics, I would tell you, they have a free webinar every morning. It's 2 hours, so you don't have to watch it all, and you can watch them on YouTube. Go watch these guys. I'm telling you, even if you don't trade futures, and most of you don't, this is you will get a graduate level education in a month. Listen to these guys talk about the futures markets and currencies and oil and things like that. So I'm not really going to take questions today just because we went through a lot of material. This is going to be 45 minutes as it is. But if you are not a member, you want this stuff and everything else that I have public, go to fundamentaltrends.com and just get the free library card. Right? It's just like signing up for a newsletter. So get the free library card, and you will get one. I think this is a nifty picture. I edited that myself. You get our special reports every quarter, quarterly outlook, several pieces monthly of members only research, and you get to check the archives, which I'm going to be a little less generous with some of the things I'm giving away, but this website really has relaunched recently in the last year, and I like to build it up. What you really will like about Fundamental Trends is if you're a trader, if you want to swing trade, right? If you don't need to swing trade, margin of safety investing is dandy for you, right? But if you're a swing trader or you want to swing trade or learn how to swing trade, then this rare service is what you want. Use the code SMART50 or RARE50, either one, and you get it for half price. All the other services here, you can pick and choose. If you just want ETFs, Global Trends ETF is $299 a year. Again, use code SMART50 and you get it for half price. Sustainable growth investing, if you don't really need dividend stocks and you just want to grow, sustainable growth investing includes Global Trends ETF, right? Retirement, life, growth, and income, again, I believe $299 a year. Then retirement income options, if you have a portfolio and you want growth and you want income and you want to use options to generate more income, covered calls, cash secured puts, this is essentially what margin of safety is. Margin of safety at Seeking Alpha is retirement income options plus retirement growth and income plus sustainable growth investing plus Global Trends ETF. Then I have a standalone 401k service, which really takes a lot of work. So I'm not sure if I'm going to keep it. It's a lot of work for a little bit of money. I think I'm going to merge it into the Global Trends ETF, just offer the asset allocations. And people who want to call me for consulting can do that. Or either that or I'll partner with somebody that runs something similar. But I was going to build a database of all the retirement plans, and it's just too hard. I'd have to hire a lot of people. I'd never make any money. So I'm just going to build in the asset allocations, I think. But, if you want to take a look at this, go ahead. Otherwise, free library card, get you access to quite a bit of stuff. And come back on Friday mornings if you want to see this live. Otherwise, go to the YouTube page, and it's all right there. I will be posting this for members privately on YouTube, and then I'll make it public in about 2 or 3 weeks after we get down to these levels. You know, I'm not going to make this public just yet unless you sign up for the free library card, and then you can get the link. So if you get the free library card, you get the link to this video to review, and you get the article. All right, Forex Analytics with an X. It's in today's article on Seeking Alpha. So bearing oil with no resurrection in sight. For whatever reason, people, tell you what, folks who are buying Exxon right now are just going to get crushed. I'm going to make sure I like my own article. But yeah, here, Forex Analytics. There you go. That's it right there. All right, have a great night. Should we take a look to see if there's anything happening in the futures market just yet? Actually, probably can see it right here. Do we have futures yet? I don't know if they've opened. Data flash. I don't see anything. Yeah. These guys do Elliott waves too. Interesting. Harmonics is interesting. Candlesticks are easy, basic, technical. So I have a lot of resources that I use. And I do know that the technical analysis that I've employed and re-engineered in the last year and a half has become very, very good. So I've tried to make it as easy as possible to follow along with what I'm doing. So read the article I have on technical analysis, and you will become a better investor, I promise. All right, take care, everybody.